Okay, let's start. We want to continue from where we left. We were doing the topic of reconstruction, and we had finished the area of internal reconstruction. So now we want to go to the second way of reconstructing a company. So let me introduce it. Now, assuming you're a company called A, and you're the company being reconstructed, and you want to reconstruct yourself through external reconstruction. Last time I told you, another company, let's call it company B, will have to come in and buy the business of company A. We said when it comes to external reconstruction, one company will sell their business to another company. This company buying A is either another existing company, or it could be a newly formed company, In other words, we can form company B so that it takes over the business of company A. Now, which means company A selling their business to company B, we shall be calling company A the selling company. We shall be calling them the selling company, while company B, which is buying company A, we shall be calling it the purchasing company. We shall be referring to it as the purchasing company. Good. Now, so what we want to look at now are the accounting entries. Now, before we look at the accounting entries, it is required, listen, company A being that they are the one being reconstructed. This company A, it is required that they must liquidate themselves. In other words, company A must be liquidated so that they sell their business to company B, In other words, we have to close the books of company A. And company B now will be required to open their books. So company A will be said to close their books, while company B will be said to purchase or to open their books. So whenever you are tested on this topic of external reconstruction, the examiner would normally ask you to show the entries in the books of company A, which is the company being liquidated, and you also show the entries in the books of this purchasing company, which is B. So I want to start with the entries in the books of the selling company. And I've said before we start, an external reconstruction occurs where a company is liquidated and they sell their business to another existing company or a newly formed company. That's how external reconstruction occurs. So maybe before we talk about the accounting entries, the books of the selling, put down this statement. So the topic is external reconstruction. Put down the topic external reconstruction. Then you say this, external reconstruction. Then you say this. This occurs where a company is liquidated. And they sell their business. A company is liquidated and sell its business, and it sells its business to another company. They sell their business to another company. Continue. The purchasing company Purchasing company could be another existing company or a newly formed company. The purchasing company could be another existing company or a newly formed company Good. Let me now introduce the entries in the books of the selling company. Entries in the books of the selling company. Entries in the books of the selling company. Okay, so let me introduce them. So let me talk about them first. Entries in the books of the selling company. Okay. Now, before we continue, listen. There are some people who have joined this class. If you are new to this group, listen. If you are new to this group, please subscribe. If you are new to this group or you are watching this for the first time, please subscribe to my YouTube channel so that you will be notified whenever we post videos to the YouTube. So if you are new to the channel, or you're watching this for the first time and you have not subscribed, please subscribe to my YouTube channel so that you will be notified whenever we post new videos to the YouTube. Okay. Now, so please subscribe. You can even click that subscription button just below down there. You can click that subscription button even as you're watching this video. Please subscribe. If you have not subscribed, please subscribe to my YouTube channel so that you get notification. Okay? Now, another point. This is to everybody now. We are doing advanced financial reporting. So please tell your fellow students who have not joined the group that if they want to join the online classes, we have them. Tell your friends about our online classes for advanced financial reporting. Tell them about, we have either early morning classes or evening classes, or they can buy what we call pre-recorded videos. Tell them we also have financial reporting of the intermediate level. We have online classes, or they can also buy what we call pre-recorded videos. Tell your friends about also financial accounting of the foundation level and that of the ATD level 1 and level 2. We also offer online classes for that subject. So those are the 3 papers I'm offering online classes on. So remember to recommend the fellow students who have not joined us or any of your friends to our online classes. Good. So either advanced financial reporting, or financial accounting. Good. Let me proceed from there now. So let me introduce now what are the accounting entries in the books of the selling company. We are taking our selling company as A. Listen, I have told you, company A must liquidate themselves. In other words, they must close their books. And you all know, whenever a company is liquidated, the stakeholders are normally paid what is due to them. So we want to close the books of company A so that these stakeholders could include ordinary shareholders, preference shareholders, whoever they are, the stakeholders, debenture holders, they have to be paid what is due to them so that they sell their business to company B, So what we want to talk about now is, how do you as company A close your books? Let me go through the accounting entries in the books of company A. Number 1, don't write. Let me go through first. Number 1, whatever assets, listen to this, whatever assets you as company A you have, which B decides that they are going to take over from you those assets, then you, A, you are required to close all assets taken over. You close all assets taken over by the purchasing company. You close them at their book values. You close them at their book values to an account we shall be calling realization. Close them at their book values to an account we shall be calling realization. That's step number 1. That you, company A, close all assets taken over by the purchasing company at their book values to an account we call realization account. The question will tell you which assets of company A were taken over by company B. The question will tell you, okay? So let me now assume that we have been told the assets, whichever they are, we have been told the assets. So I go and credit the assets. I will credit the assets and debit an account called realization. That is step number 1, which says close all assets taken over at their book values to the realization account. Whatever the assets, whether it's machinery, motor vehicle, furniture, so long as the question tells you company B took them over. Company B took them over. That's what you do first. That's number 1. Number 2. Number 2 is you as company A again. You may be having some of your liabilities which company B decides that they are going to take them over from you. Company B is buying you, but B says they are going to take over your creditors, they are going to take over your debentures, they are going to take over your bank loans, and so on. So our entry number 2 is with liabilities taken over. With liabilities taken over, you as company A, you close those liabilities to their gain to this account we are calling realization. We all know liabilities are always a credit balance. Liabilities are always a credit balance, and therefore to close them, you will go debit that liability and you will credit realization, and you will credit realization. So that's our entry number 2. It says with liabilities taken over, you debit liabilities, you credit realization. That's our entry number 2. Let me go to number 3 now. Let me go to number 3. Listen, you company A, you are selling your business to company B. You company A, you are selling your business to company B. Listen, there must be something that you as company A, you are charging company B to buy you. Whatever it is that you are charging them, whatever it is that you as company A, you are charging B to buy you, that's what we normally refer to as the purchase consideration. As the purchase consideration. So what is it that you company A, you are charging B to buy you? Okay? For purpose of illustration, let me assume, purpose of illustration, I want to assume that you company A, you are charging B 50 million for purpose of illustration. So you will go and debit, that's our entry number 3, you will debit the purchasing company, which we are calling B Limited, by that 50 million, and you will credit realization by that 50 million. Listen, we are charging them. Listen, I am not saying that they are paying me 50 million now. No, I am charging them. Me, company A, I am charging B that 50 million. In other words, I am creating a data in the name of company B. Me, company A, I create a data by the name of company B. I charge company B 50 million. They will pay me later, but for now, let me charge them that 50 million. With that 50 million, you will debit the purchasing company and you will credit realization. So in the realization account, you come and see here, B Limited, 50 million. That's our entry number 3. That's our entry number 3, which says with the purchase consideration, debit the purchasing company and you credit realization. That's number 3. Number 4. Number 4 is, listen, we have already said, you as company A, you must liquidate yourself. You as company A, we said company A should be liquidated. In the process of you, company A, liquidating yourself, you may be required to incur some liquidation expenses. You may be required to incur some liquidation expenses. Maybe you have to spend 2 million for you to liquidate yourself so that you can sell your business to company B. Now listen. So our entry number 4 says, with liquidation expenses, if you company A, listen, if you company A, you paid for yourself that liquidation expense, maybe it's 2 million. You will have to debit realization. You will have to debit realization and credit bank. With the liquidation expenses, you will debit realization and credit bank if you are the one who paid for yourself, you as company A. Listen, it may happen that you company A, you don't have that 2 million shillings so that you can liquidate yourself. Yes, it will cost you 2 million to liquidate yourself, but you don't have that money to liquidate yourself. But company B wants to buy you. So company B may decide they will pay that 2 million on your behalf. The cost of liquidation is yours, you company A. But maybe because you don't have the money, B says they will pay it on your behalf. They will pay it on your behalf. Okay? So in that case, listen, in that case, you company A, you have incurred that expense, but you have not paid. You have incurred that expense, but you have not paid. It will be paid for by B Limited. So in your books, you company A, you create a liability for that liquidation expense. You have to pay it. When you receive the 2 million from B, it is that time when you will pay it. But before then, you are incurring that expense, you have not paid. So if you have incurred but not paid, you as company A, you will still debit realization and you will credit an account we shall be calling provision for liquidation expense. In other words, you create a liability account. Debit realization still, and you credit this account we are calling provision for liquidation. That is your liability that you are creating. So that once you receive the 2 million later, you will now pay through this account. You will now pay through this account by debiting this account called provision for liquidation, credit bank. That's our entry 4, which says, with the liquidation expenses, if paid by the selling company, debit realization and credit bank. If incurred but not paid by UA, you will still debit realization and you credit provision for liquidation expense. That's our entry 4. That's our entry 4. Stays with the liquidation expense. Let me go to number 5 now. Let me go to number 5. For number 5, I want to take you back to number 1. I want to take you back to number 1. Number 1, I said, close all assets taken over. Close all assets taken over at their book values. Suppose you company A, you have an asset, let's call it maybe motor vehicle, which company B does not want to take it over from you. I've told you, company A must liquidate themselves. Whenever a company is liquidated, that company will not remain with any account pending. Once a company is liquidated, all accounts must be closed. All accounts must be closed. There can be no account pending. So here is an asset. Could be machinery, could be motor vehicle, which company B does not want to take over from us. But we do as company A. Listen, we as company A, we may decide to sell it to somebody on our own. That's our entry number 5, where we are saying, with any assets not taken over, with any assets not taken over by the purchasing company but sold by you, A Limited, with any assets not taken over by the purchasing company but sold by the selling company, you are receiving cash. You will debit cash, whichever the amount, you will debit cash and you will credit the asset. When you're selling that asset, let us assume it's motor vehicle, you will go to that motor vehicle account. Let us assume it has a book value, balance brought down, of 2 million. Then the question told you company A sold it for 1.5 million. So we debit bank and we credit the asset called motor vehicle by 1.5 million. Then whatever balance will be in this motor vehicle account, that balance being either a gain or loss on disposal of the asset, you take it to the realization account. Don't forget, we are not running a normal business, just like we were discussing when we were doing internal. We are reconstructing our business. We are not running a normal business, we are reconstructing. When it comes to external reconstruction, our operating account is realization account. So whatever is the gain or loss on disposal, which in our case here is a loss. We sold an asset for 1.5 million when the book value was 2 million. We made a loss of 500. I will credit the asset by that 500. I will debit realization. If the question told me I sold it for 2.5 million, meaning I debited bank, I credited motor vehicle by 2.5, then I sold it at a gain. That gain, I will debit motor vehicle and I will credit realization. Good. That's all. That entry number 5. What is that entry? Saying with any assets not taken over by the purchasing company but sold by the selling company. You will debit bank and you will credit asset. You will debit bank and you credit the asset, whichever the asset. Then I've said with whatever balance is in the asset account, being either gain or loss on disposal, you transfer it where? The realization account. That's number 5. Let me go to number 6 now. Number 6. For number 6, I want to take you back to number 2. Number 6, I want to take you back to number 2. Number 2, we said, with liabilities taken over. If you gave out your creditors, we have to debit creditors and credit realization. You gave out your debentures, we debited debentures, we credited realization. That's what we did for number 2. But what if, now listen, what if you company A again, there is one of your liabilities which B says they're not going to take over. Yet we have said there should be no account pending after you have liquidated yourself as company A. What do you do with any of that kind of a liability which was not taken over by the purchasing company? Listen to this now. It means therefore that you company A, you could decide that you are going to pay that liability own. Will pay it on your own. Not taken over by B, but you A, you decide you want to pay it on your own. Let's now say, we are saying number 6 says, don't write, saying number 6 says, with liabilities not taken over, with liabilities not taken over by the purchasing company, but paid by the selling company, Let us assume it is creditors. That company B decided they are not taking over our creditors. So we decided as a company A, we shall pay for it on our own. You will go to the creditors account. We know it's a liability. Liabilities are always a credit balance, so balance brought down. Let us assume 2 million. Then the question might tell you, these creditors were willing to accept 1.8 million in full settlement. So what did you do? Debited creditors by 1.8 million and you credited bank 1.8. If you look at this account, there is a balance of 200,000. Does it mean we still owe the creditors that much? No. We owed them 2 million. They were willing to accept 1.8 million in full. Means therefore that we as a company A, we have been given a discount. In other words, we have received a discount. So if there is any discount we are receiving from our creditors, we will debit creditors that 200, and you will credit realization. And don't forget, we are not running a normal business. It's true. Discount received is a gain. So it should go to the P&L account. We're not running a normal business. We are reconstructing this company. That discount received, take it to the realization account. That's our entry 6, which says any liabilities not taken over by the purchasing company but paid by the selling company, you will debit this liability and you will credit bank. Then we are saying if there is any discount we are receiving from our creditors, then you as company A debit that creditor, credit realization. Good. Now, before we go to number 7, 8, 9, because there are about 15 entries in the books of the selling company, there are normally about 15 accounting entries. So before I go to the next one and the other remaining one, maybe we could put down something on what we have already said. We could put down something on what we have already said. So have another subheading, entries in the books of the selling company. Entries in the books of the selling company. Entries in the books of the selling company. Let's put down those entries. Entries in the books of the selling company. Entries in the books of the selling company. So let's record them. Entries in the books of the selling company. Entries in the books of the selling company. Okay. Let's start. 1. 1. Close all assets taken over. 1. Close all assets taken over. Close all assets taken over by the purchasing company. Close all assets taken over by the purchasing company at their book values. Close all assets taken over by the purchasing company at their book values to the realization account. To the realization account. Close all assets taken over by the purchasing company at their book values to the realization account. Below that, we got debit, realization, debit, realization, credit assets. Debit, realization, credit assets. That's number 1. Closing all assets taken over. Debit, realization, credit asset. Number 2, let's go to number 2. 2. With the liabilities taken over by the purchasing company, with the liabilities taken over by the purchasing company, liabilities taken over by the purchasing company, debit, liabilities, debit, liabilities, credit, realization. Debit, liabilities, credit, realization. Saying with the liabilities taken over, debit, liabilities, credit, realization. Debit, liabilities, credit, realization. That's number 2. 3. With the purchase consideration. 3. With the purchase consideration. With the purchase consideration. With the purchase consideration. Debit, purchasing company. Debit, purchasing company. In bracket, you can put datas. Don't forget, we are receiving from we are charging that data called B. Charging them Debit purchasing company, you credit realization. Debit purchasing company, credit realization. I was assuming that 50 million, that's what we are charging B. Good. That's number 3. Let's go to number 4 now. Finish, we go to number 4. Four. MIV. With liquidation expenses, paid for or incurred. With liquidation expenses paid for or incurred. With liquidation expenses paid for or incurred. Debit realization, credit bank, stroke provision for liquidation expenses. Debit realization, credit bank, stroke provision for liquidation expenses. If you paid it, credit bank. If you incurred but never paid, you credit the account called provision for liquidation expenses. Good. That is it for number 4. I want to go to number 5 now. Number 5. Let me talk about number 5 now, or we write down number 5 if you are through. Say this. Say this as number 5. With any assets not taken over. With any assets not taken over by the purchasing company. With any assets not taken over by the purchasing company, but sold. With any assets not taken over by the purchasing company, but sold by the selling company. Any assets not taken over by the purchasing company, but sold by the selling company. Debit, bank, credit asset. Any assets not taken over by the purchasing company but sold by the selling company. Debit, bank, credit asset. Then below there, andika NB. Below there, andika NB. Below there, NB. With the balance in the asset account. Balance in the asset account. Balance in the asset account being either a gain or loss on disposal. Balance in the asset account being either gain or loss on disposal. Balance in the asset account being either gain or loss on disposal, transferred to the realization account. 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 Good. That's number 5. 6. Finish. 6. 6 says, with any liabilities not taken over. Any liabilities not taken over by the purchasing company. With any liabilities not taken over by the purchasing company. Any liabilities not taken over by the purchasing company, but paid by the selling company. Any liabilities not taken over by the purchasing company, paid selling company. Paid selling company. Debit liabilities Debit liability, credit bank. Debit liability, credit bank. So whichever liability. Debit that liability, credit bank. Then just below that, NB. Below that, NB. Below that, NB. Then you say this. With any discount received from creditors, with any discount received from creditors, debit creditors, any discount received from creditors, debit creditors, credit realization. Debit creditors and your credit realization. This is where you paid them less. You are gaining, a gain to us, so we debit creditors and we credit realization. Okay, those are the entries we have talked about so far. Finish. I want to develop the other entries. I want to talk about the other entries now. Finish. I discussed the other entries. We said in the books of the selling company, there are 15 accounting entries. Let me go back and discuss a few more. Let me go back and discuss a few more now. Okay, so let me discuss a few more before we put them down. So far we are at number 6. Listen to this now. Listen. We said, when a company is liquidated, all the stakeholders of the company should be paid what is due to them by the end of the day. Because we are liquidating this company. So the stakeholders should be paid. Who are the stakeholders? The ordinary shareholders, preference shareholders, and any other stakeholder. Now listen. Take, for example, the stakeholder by the name ordinary shareholders. As a company A, there are so many things that you could be owing to the ordinary shareholders, listen, whereby when it comes to reconstruction, listen, we don't pay them through those various accounts. For example, it is obvious as a company, we owe the ordinary shareholders their capital. So whatever balance is in the ordinary share capital account, that share capital is an amount that you owe the ordinary shareholders. The amount in the share premium also is an amount that belongs to the shareholders. The amount of the general reserve is another amount that you owe the ordinary shareholders. In other words, we are saying there are too many things that as a company you may owe to the ordinary shareholders. Listen, but when it comes to paying them, we normally don't pay them those amounts through those respective accounts. No, listen, what you do, you open one liability account for everything that you owe to the ordinary shareholders. You open one account for them, whereby you take everything that you owe to them into that account, listen, so that when the time of paying them comes, you will only pay them once, but not in piecemeal. So for stakeholders, if you owe them more than one, you need to first open an account for them. So like ordinary shareholders, of course, I owe them more than one thing. I owe them for their capital. I owe them for their reserves, whichever reserve, whether it's a positive reserve like share premium, general reserve, revaluation reserve, or even a negative reserve like the retained losses. They are still a reserve and they belong to ordinary shareholders. Give it to them. Take it to that account. Good. Now listen. So our step number 7 says you transfer the balance of the ordinary share capital. Transfer the balance of the ordinary share capital to an account we shall be calling, ordinary shareholders members account. You open an account called ordinary shareholders members. This represents, listen, this represents a liability account for everything that we owe to the ordinary shareholders. So you open an account called ordinary shareholders members. Some books will call it ordinary shareholders sundries members account, whichever it is. I close the share capital or ordinary share capital, and I close it by debiting. You know share capital is a credit. You close it, debit that share capital, and you credit the members account, whatever it is. Good. Somebody's asking a question. Let me see. Somebody saying, for number 6, will the examiner mention that the discount was by creditors? Maybe yes, maybe no. But if you go to the balance sheet, I'm talking to who now? I'm talking to Moses. If you go to the balance sheet of that company and you find the debentures, no, the creditors are 2 million. Then an additional information tells you creditors were willing to accept 1.8 million in full settlement. But when you go to the balance sheet, you find the creditors are 2 million. And the note says they are willing to accept 1.8 million in full settlement. Then, of course, once you pay them 1.8, that account will have a balance. You can't leave it pending because we are closing the books of company A and we don't owe them anything more. That means we have received or we have been given a discount. When you pay less to the creditors than what you owe to them, then they are obviously giving you a discount. So the examiner doesn't have to tell you that you are paying them at a discount. No. But you know from the question in the balance sheet, you owe them 2 million. But the note says they are willing to accept 1.8 million in full settlement. Then automatically you know is a discount we are receiving. Okay, thank you, Moses. You have said you have understood. Thank you. So let's go on. So I'm still under number 7. Let me revisit it. I was still under number 7. I was saying this. We shall have to pay the stakeholders. One group of the stakeholders are the ordinary shareholders. And I've said this. There's a lot you owe to them, but you can't pay them through those accounts in piecemeal. No. I've said, ordinary shareholders, there's too many things. So what you do, you open a liability account for them, whereby take anything you owe to the ordinary shareholders, that account. Then when it will come to the time of payment, you will pay them only once, but not in piecemeal. We have done one entry. That is the amount we owe them, their capital. Said step number 7 says, transfer the balance of the ordinary share capital, the ordinary shareholders members account. I've debited share capital to close it because share capital is always a credit. Close it, you debit share capital and you credit members account. That's what I've done. That's number 7. Let me go to number 8 now. We go to number 8. 8. Listen, just told you there's a lot we owe to the ordinary shareholders. What else could we be owing them? You owe them their reserves. Number 8 says, transfer reserves. Transfer reserves to the ordinary shareholders members. You transfer reserves. Listen, whether the reserve is a positive reserve or it's a negative reserve, it still belongs to the shareholders. So if it's a positive reserve like share premium, we know share premium is always a credit balance. To close it, you will debit that share premium and you will credit the members. That's what you will do with that amount which you owe to them in terms of share premium, or maybe it's a general reserve. General reserve is also a credit balance, or it's a revaluation reserve. It's also normally a credit balance. To close that credit balance, you debit the reserve and you credit the members. Let us assume you are dealing with share premium. I'm going to debit share premium and credit the members account. That's our step 8. It says, listen, transfer reserves. I've said Some reserves could be positive, some reserves could be negative. Listen, if you have a negative reserve, like the retained losses, listen, which will always be there. Why? Because that's why we are reconstructing the company. Remember when we started, we said, why do we reconstruct a company? To help the company to do what? To eliminate the accumulated losses. To eliminate the accumulated losses. So it is obvious this company will have losses. It's a retained loss. It's a reserve. And a retained loss, if you go to the P&L account of that company, you will find that that P&L account has a debit balance. Losses are always a debit balance. That is an amount that belongs to the. So to close that P&L, we'll have to credit P&L and you will debit the members. You will credit P&L and you debit the members. In other words, give them their share of loss. Credit P&L account and you debit the ordinary shareholders, members. Come and see a P&L account, whatever it is. So I am through now with step number 8. Says transfer reserves. It's positive or it's negative. Positive, will debit that reserve, whichever it is, and you credit ordinary shareholders. If it's a negative reserve, like retained losses, which will always be there, credit P&L account, debit them. That's our entry number 8. We go to number 9. Listen to this now. When it comes to number 9, I want to take you back to number 1 and number 5. For number 9, I want to take you back to number 1 and number 5. Number 1, we said, close all assets taken over. That's what we did. Number 5, we said, with any assets not taken over but sold. That's what we saw in number 5. Any assets not taken over, sold. Now, it may happen that you, company A, you have some more assets which company B did not want to take them over under step number 1. 2, you as company A, you could not get somebody to sell them to under step number 5. What do you do? Yet, said, whenever a company is liquidated, all accounts must be closed. You cannot leave the accounts pending. No. So if you have some assets, you as A, which could not be transferred to B under step 1, and you A, you could not get somebody to sell them to under step 5, then the question is, who within our company will take over the loss of such an asset? Because we can't leave such accounts pending. So who within your company will take the loss of such assets? Obvious, it is the owners of the company. And the owners of the company are ordinary. When you have such assets, we refer to them fictitious assets. Fictitious assets. For example, in your books as company A, you may have assets like goodwill. B doesn't want to take over goodwill. 2, you can't get somebody to sell to that asset called goodwill. You may have an asset called patent, copyrights, trademarks. These are assets that maybe B does not want to take them over from you. At the same time, you A, you can't get somebody to sell them to. So let the owners of the company take over the loss of such assets. Who are the owners? They are the ordinary shareholders. So number 9 says, we transfer fictitious assets to where? To the account called ordinary shareholders, members. We know assets are always a debit balance, and therefore to close that asset, you will go and credit that asset, whichever the asset it is, and you will debit the members. Come and say your fictitious assets. Whether the asset is goodwill, whether the asset is copyright, trademark, patents, whatever the fictitious assets you are given in that question. Good. That's our step number 9. Listen, before again I go to number 10, listen, I hope you have noticed, as I was discussing, that entry number 7, 8 and 9, they are all related. Hope you have noticed that. At entry number 7, 8 and 9, they are all related. In what sense? Sense that these are things that belong to the ordinary shareholders. These are things that belong to the ordinary shareholders. Good. 1 is ordinary itself, that is number 7. 2, reserves. 3, any fictitious assets belong to ordinary. Listen, told you the company is liquidated. The stakeholders must be paid what is due. Also told you that you can't pay them through the respective account. No. Another group of stakeholders your company may have are the preference shareholders. That's another group of stakeholders they have. So if as a company, again, from the question you realize that this company has preference shareholders, again, you can't pay them their preference share capital through a share capital account. No. Again, you create a liability account for anything that you owe to the preference shareholders. Take it to that account. That when the time of payment comes, again, you pay them once, but not in piecemeal. One other thing that you be owing, one thing that you could be owing to the preference shareholders is their preference share capital. So number 10 says, transfer the balance. Transfer the balance of the preference share capital. Transfer the balance of the preference share capital to an account we shall be calling, preference shareholders members. We will open a liability account by the name of preference shareholders members. We know preference share capital is always a credit balance. No preference share capital is always a credit balance. Therefore, to close that share capital, we'll debit that share capital and you'll credit the members. Come and say a preference share capital, whatever it is. Okay? Good. Now listen. Still under number 10, we need to ask ourselves, is there anything else that as a company we could owe to the preference shareholders? The answer is yes. That is dividends that are still in arrears. Dividends that are still in arrears. Another thing to remember is this. When we were doing internal reconstruction, we saw that when your company has not paid the preference shareholders their dividends, then, listen, we said preference dividends in arrears don't appear in the books. Remember where we were saying, even if you go to the balance sheet of the company, you will never see a liability called preference dividends in arrears. But for your company, you know you have not paid them for the last 2 to 3 years, whatever the question will tell you. So when we were doing the topic of internal reconstruction, said, when you as a company, you come across such a liability, which we were calling a contingent liability. Don't forget we were giving an example, contingent liability as preference dividends in arrears. So we are saying, when we were doing internal reconstruction, we had to crystallize that liability. How? Remember, we were debiting the account called capital action. And then we were crediting the account called contingent liability. Told you, if you know the name of your liability, open an account in that name. We had to crystallize that. The same thing now also applies to external reconstruction. We are reconstructing company A. The preference shareholders have not been paid their dividends for the last 2 years, 3 years. When you compute the amount you get, it is 30,000, whatever it is that you have not paid them. If you go to the balance sheet of the company A, you will not see a liability called preference dividend arrears. Yet, as a company A, we have not paid them their dividends. Again, you have to install that liability. So our still under number 10 saying, under number 10, if there is any preference dividends that are still in arrears, these are amounts that you owe to the preference shareholders. You need to increase what you owe to them. So with the arrears, you will debit realization. You will debit realization with whatever is the preference dividends in arrears. You will debit realization and you will credit provision. You will credit preference shareholders members. We have a liability for them. This time you don't open an account called preference dividends in arrears like we were doing for internal construction. That time we did not have a liability for them. But now we have a liability called preference shareholders members, where you take everything that you owe them, that account, just like we have done the ordinary. So for these guys, we owe them another thing called preference dividends in arrears. So we go debit realization and we credit preference shareholders members. That's our entry 10. Number 11. 10 through relates to the preference. Now listen, number 11. For number 11, I want to take you back to number 3. Number 11, I want to take you back to number 3. Number 3, we said, with the purchase consideration. And we were charging them, if you remember, we were charging B Limited some 50 million. We as company A, we were charging B 50 million. So I told you that time when we were doing number 3 entry, create a data by the name of company B, which we did. I can see it here, debited purchasing company B, we credited realization with that 50. Now listen, a time has come for company B to pay us that 50 million. B may decide he will pay you that 50 million, either all of it in cash, or B may decide he will pay part of that 50 in terms of cash, part in terms of shares, and part in terms of debentures. He can give you cash, partly shares, partly debentures as a payment of the purchase consideration. That's what we want to do under step number 11. We are saying, listen, by 11 we are saying, with the receipt of the purchase consideration, with the receipt of the purchase consideration, either in form of cash, shares, or debentures. If you are receiving cash, you will debit cash. Let us assume the question tells you you are receiving cash of 10 million. You will debit cash of 10 million and credit the purchasing company. See your cash, 10 million. If you are receiving shares, you will debit shares, 20 million, I'm assuming. Listen, we are debiting shares as an asset. I am not the company issuing the shares. Me, A, I am receiving shares. Get the point there? I am not the company issuing the shares. When a company issues shares, they must credit share capital. But me, I'm receiving them as an asset. I am debiting shares of B Limited in my books. Okay? I am recognizing an asset. I'm debiting shares of B Limited and I'm crediting crediting the purchasing company 20 million. Let me assume that B also decided to pay you in terms of debentures. You, A, again, you are receiving debentures, not issuing, you are receiving debentures as an asset. You will debit debentures, let me assume by 20, and you credit the purchasing company, that's 20 million. I've done my step number 11 says, with the receipt of the purchase consideration, either in form of cash, shares, or debentures. If cash, debit cash. If shares, debit shares. If debentures, debit debentures. And you credit the purchasing company. That way you are receiving from data. Before I go to number 12, 13, and 14, and 15, let's put down those which are to put as extra ones that we have added. Let's go back. Notes now. We were at step number 7, I think. Number 6. Let's now go to number 7. Stopped at number 6. Now let's go to number 7. As part of the notes now. As part of the notes. Say this. 7. Put down this. Transfer the balance. Transfer the balance. Transfer the balance of the ordinary share capital. Transfer the balance of the ordinary share capital to transfer the balance of the ordinary share capital to the ordinary shareholders members account. Transfer the balance of the ordinary share capital. Transfer the balance of the ordinary share capital to the ordinary shareholders members account. Transfer the balance of the ordinary share capital to the ordinary shareholders members account. Okay, we debit ordinary share capital. Remember, it's the one we are closing. Debit ordinary share capital. And we credit ordinary shareholders members. Ordinary shareholders members account. Ordinary shareholders members account. That's our entry number 7. For the balance of the ordinary share capital to ordinary shareholders members account. Debit ordinary share capital. Credit ordinary shareholders members. Okay. Number 8. 8. Okay, this. Transfer reserves. Transfer reserves. Transfer reserves to transfer reserves to the ordinary shareholders members account. Transfer reserves to the ordinary shareholders members account. Transfer reserves to the ordinary shareholders members account. Transfer reserves ordinary shareholders members account. Under number A, andika under number 8, andika A. Under number 8, andika A. If positive reserve, if positive reserve, e.g. share premium, if positive reserve, e.g. share premium, debit share premium, debit share premium, credit ordinary shareholders members, credit ordinary shareholders members. If positive reserve, e.g. share premium, debit share premium, credit ordinary shareholders members. B. If negative reserve, B. If negative reserve, e.g. if negative reserve, e.g. retained losses, debit ordinary shareholders members, debit ordinary shareholders members, credit P&L, debit ordinary shareholders members, credit P&L. credit P&L. Good. That's number 8. Number 9. 9. Number 9. 9. Say this. Transfer fictitious assets. Transfer fictitious assets. Transfer fictitious assets to the ordinary shareholders members. Transfer fictitious assets to the ordinary shareholders members. Debit ordinary shareholders members. Debit ordinary shareholders members. Credit fictitious assets. Credit fictitious assets. Debit ordinary shareholders members. Credit fictitious assets. Debit ordinary shareholders members. Credit fictitious assets. That's number 9. 10. 10. 10. Transfer the balance of the preference share capital. Transfer the balance of the preference share capital to transfer the balance preference share capital to the preference shareholders members. Transfer the balance of the preference share capital to the preference shareholders members. Debit preference share capital. Debit preference share capital. Credit preference shareholders members. Debit preference share capital. Credit preference shareholders members. Said number 10. Transfer the balance of the preference share capital to the preference shareholders members. Debit preference share capital. Credit preference shareholders members. Till under number 10. Till under number 10, andika NB. Till under number 10, andika NB. Till under number 10, NB. With any preference dividends in arrears. Any preference dividends in arrears. Any preference dividends in arrears. Debit realization. Debit realization. Credit preference shareholders members. Debit preference share capital. Debit realization. Credit preference shareholders members. Remember, this is an amount you owe to them. Take it to their liability account, which we are calling preference shareholders members. Saying last time, the company in the internal reconstruction, we were debiting capital reduction. Now we are not debiting capital reduction, we are debiting realization. And you credit the members. Remember, we are crystallizing that liability. Good. That's our entry number 10. Let's go to number 11. Let's go to number 11 now. Okay, number 11, we say it. Put it down. With the receipt of the purchase consideration. With the receipt of the purchase consideration. Either in form of cash, shares, or debentures. With the receipt of the purchase consideration. Either in form of cash, shares or debentures, the receipt of the purchase consideration, either in form of cash, shares, or debentures. Debit, cash. Remember, this time we are receiving debit cash, debit shares, debit debentures. Told you we are receiving these things, not issuing them. We are receiving, so we are debiting them. Debit cash, debit shares, debit debentures, and we credit purchasing company. Can put in bracket data. Don't forget, when I was charging them in number 3, that time I debited the data. Now we are receiving that data. Good. That's our entry by 11. Allow me to go back now to 12, 13, 14, 15. Still have some 4 more. Go. Let me first discuss them. So far we have discussed only up to number 11. Let me go to number 12 now. Finish. Discuss number 12. Hope you are through. Copying. Fine. So let's go on. We go back. Here, number 12. Listen. We have just received cash. We have just received shares. We have just received debentures as a form of payment. Listen to this now. Now a time has come that we as company A, we have the resources now. We have the money. I told you, whenever a company is liquidated, the stakeholders should be paid what is due to them so that they go their way and then they sell their business to company B. Now the question is this. Now that we have received cash, we have received shares, we have received debentures, who among our stakeholders should we pay first? Should we pay the preference shareholders first? Should we pay the ordinary shareholders first? That's what we want to find out. Just because we have received. We have the money now. Yet, from this illustration, we opened a liability account for the ordinary. We opened a liability account for the preference. So, in order of priority, you know that whenever a company is liquidated, normally preference shareholders rank first in order of priority. So, now that we are liquidating this company, company A must pay the preference shareholders first. So, our entry number 12 says, pay preference shareholders what is due to them. Pay them what is due to them. Listen, out of the cash that you have received, the shares and the debentures, the question will tell you how much of the cash. But you received cash. Where is it? You received cash of 20 million. Where did I debit it? Here. We received cash of 10 million. The question will tell you how much of that 10 million are you giving to the preference shareholder? Could be they are getting everything. Just go and credit cash, and you debit the members now that you are paying them. Go where you opened the account called preference. Come and debit here. See your cash. Paying them. If the question tells you you are paying them the shares that we received, go to that shares account and you credit it. We received it as an asset. Go credit the shares and you debit the members. Is the preference here? Come and see your shares. If the question tells you you are giving them debentures, you received the debentures as an asset. Now use it. Go credit shares, credit debentures, sorry. Where did we open it? Here. You go credit debentures and you debit members. That's preference shareholders members. So I've done step number 12. Says, pay the preference shareholders what is due them, either in form of cash, shares, or debentures. You credit cash, credit shares, you credit debentures, and you debit the shareholders' members. That's your liability. I've done step number 12, which says, pay the preference shareholders what is due them. Number 13. Before I write it down there, let's go back to that account. We have just paid the preference shareholders what is due to them. Listen. Suppose when you look at this account, on the credit side, meaning what you owe to the audit to the preference, let me assume you added got 20,000, whatever it is. Whatever you owe to the creditors to the preference, you credited. When I add the payments here on the debit, let me assume they come to 18,000. Whether I am adding ordinary shares, cash, I get 18. That's what I'm assuming. So according to this account, I owe my preference shareholders 20, but I can see I'm paying them only 18. There's a difference of 2,000. That 2,000 is what we call either a gain or loss on payment. Are we paying our preference shareholders at a gain to us or a loss to us as a company? Currently, I can see we owe them 20 on the credit side, but the debit shows we are giving them 18. That means there's a gain of 2 million. And you take it to the possession account. There's a gain on payment. What if you owed them 20 credit, but on the debit you are paying them 28 totals? There's a difference of 8, which is on the credit. So if you are paying them more than you owe to them, that's a loss on payment. And still take it to the realization account. So that's our step number 13, which says, with the balance in the with the balance in the preference shareholders members. With the balance in the preference shareholders members being either a gain on payment. If it's a gain, go and debit realization. You debit the members, like that 2,000, debit the members and you credit realization. Go to your realization account, you'll credit. Come and say your preference shareholders. Whatever it is. If it's a loss, of course, you credited the members, debit. Through with my step number 15. Says, balance in the realization account. Balance in the preference shareholders members being either gain or loss on payment. Despite 2, the realization account. Number 14. Number 14 now, you come to this account called realization account. You want to know, listen, we as A Limited, we are selling our business. Are we selling our business at a gain or loss? We are selling our business to company B. But are we selling our business at a gain or loss? If you look at this account called realization, on the debit side of it, that's what I gave out, me as company A. All these assets, plus the liquidation expenses I incurred. On the credit side, I am charging these guys 50. So there will be a balance in this account. That balance could either be on the debit or on the credit side. It is that balance that we are saying becomes the gain or loss on realization business. If the amounts you are giving out on the debit are more than what you are receiving on the credit, then that means the difference is on the credit side then you are selling your business at a loss. You as company A, you are giving out more than what you're receiving. That is a loss. If you are giving out less on the debit than what you are receiving on the credit, the difference being on the debit means what? You are receiving more than what you are giving. That becomes a gain on realization. Question is, who takes over that gain? Of course, it is the owners of the company will take over the gain or loss on selling their business. Who are the owners? Ordinary. Let me assume we made a gain. We'll debit the realization and you'll credit the ordinary shareholders, members. Give them their gain. Debit, realization, and you credit the ordinary shareholders, members. Give them their gain. Of course, if it's a loss, you will have credited the realization because you are giving out more on the debit than what you are receiving. Then it means you are selling your business as a loss. Credit realization, debit the. That's our step number 14. 15 and the last one. 15 and the last one. This is with the balance in the realization. Number 15 and the last one is who are the last guys to be paid? Obvious, they are the ordinary shareholders. We want to pay the last guys and everybody now goes their way. Our step number 15 says pay ordinary shareholders what is due to them. Listen again. We received cash. We received shares. We received debentures. Go find out from the question. What among those items are you using to pay the ordinary? Could be the question tells you you're giving them cash. Could be the question tells you you're giving them shares. Could be the question tells you you are giving debentures, whatever the payment. Or if you are giving them cash, go pick that cash from where you received it. Where is it? Here. You credit that cash. If you are giving them cash, and you debit the members. Who? The ordinary shareholders, members. Come and say your cash. Whatever it is. If you are giving them shares, credit the shares. Debit the members. Debit the members. Same, if you are giving them debentures, you received it as an asset, so go credit that asset, debit the members. Now listen. Once you pay the ordinary shareholders, the last person, there should be, listen, there should be no account with a balance at all. All accounts should now close automatically. Why? Because they are the last people to be paid and they have even taken over the gain or loss on selling of the business. Once I pay them, all accounts should automatically close. There should be no account pending at all. That way, you have dealt with the books of the selling company. That way, you have dealt with books of the selling company. Those are the 15 accounting entries, books of the selling company. So we want to go on, now put the remaining ones. Let's put down the remaining ones. We were at number what? We were at number 11. Now let's go to number 12. By 11 is where we have just received cash. We received shares. We received debentures. Then I told you number 12, now that you have received, start paying. Would you pay first? Andika number 12, pay the preference shareholders. Number 12, pay the preference shareholders what is due to them. Pay the preference shareholders what is due to them. Either in form of cash, pay preference shareholders what is due to them. Either in form of cash, shares, or debentures. Pay preference shareholders what is due to them. Either in form of cash, shares, or debentures. Okay? Debit preference shareholders members, paying them. Debit preference shareholders members. Credit cash, stock shares, stock debentures. Debit preference shareholders members. Credit cash, stock shares, stock debentures. Remember, you received them as assets. Now you are using them. That's why we are crediting. Debiting the members' account because it was initially a liability. They are paying it. Good. That's number 12. Let's go to number 13 now. 10. With the balance in the preference shareholders members account. 10. Balance in the preference shareholders members account. Balance in the preference shareholders members account being either balance in the preference shareholders members account being either a gain or loss on payment. Being either a gain or loss on payment. Then you come and say number A, being either a gain or loss on payment. Number A, if gain, debit, preference shareholders members, debit preference shareholders members, credit realization. We paid them less on the debit. We owed them, you remember, 20. You are accepting 18. That means we had a gain of 2. I'm debiting the members because I've paid them the balance on the debit. Debiting the members, crediting realization. That's if it's a gain. But B, if loss. B, if loss. Remember, we had paid them 28 on the debit, but we owed them 20. Difference of 8, you remember, on the credit. That means we are paying them more than we owe to them. Debit, realization, if loss. Debit, realization, credit, preference shareholders members. Preference shareholders members. Debit, realization, credit, preference shareholders members. Okay. We go to number 14 now. Go to number 14. Finish. We go to number 14 now. For 14, you say this, with the balance in the realization account. The balance in the realization account. With the balance in the realization account being either a gain or loss on realization. Balance in the realization account being either a gain or loss on realization. Balance in the realization account being either gain or loss on realization. A, if gain. If gain, debit, realization. Debit, realization, credit, ordinary shareholders members. Ordinary shareholders members. Don't forget, this time you don't take it to the realization. We have already closed it. So we are giving the loss or the gain of selling the business to the members. That's what we are saying. So you debit, realization, credit, ordinary shareholders members. That's their gain. Can't take it to the realization. In fact, it's the one we are trying to close. Good. Number B, if loss. That means the balance in the realization is a loss, which I told you On the debit, you are receiving more, you are paying out more, you are giving out more than what you are receiving on the credit. If on the debit you are giving out more than what you are receiving, difference is on the credit. That means you're selling your business at a loss. Say you debit ordinary shareholders members, debit ordinary shareholders members, you credit realization. Debit ordinary shareholders members, credit realization. So whether gain or loss, let the owners of the business take it. Who are the owners? The ordinary shareholders members. Finally, number 15. Finally, number 15. Finish. Finally, number 15. Say, pay the ordinary shareholders what is due to them. Pay the ordinary shareholders what is due to them. Pay the ordinary shareholders what is due to them. Either in form of cash, shares, or debentures. Pay the ordinary shareholders what is due to them. Either in cash, shares, or debentures. Debit ordinary shareholders members, debit ordinary shareholders members, credit cash, stock shares, stock debentures. Remember, you received them as assets, now you are using them to pay. That's why we are crediting them. Debit ordinary shareholders members, credit cash, shares, stock debentures. Good. So we are now through with the entries in the books of the selling company. There are many entries which one needs to remember. We shall next time talk about entries in the books of purchasing. Those ones, there are not many as these ones. No. What have we said today? We have discussed how to deal with the recording of the transactions in the books of the selling company. One, I told you, listen. One, I told you, close all assets taken over to where? To the realization account. How? At their book values. That was the key word there. Book values. 2, with liabilities taken over, you close them again. The account called real. Said you debit liability, credit real. That was number 2. 3, I said, with the purchase consideration, you create a data by the name of the purchasing company, whatever the name the question will give you. I'm assuming company B, debit B limited, credit realization. That's number 3. 4, said with the liquidation expenses. You company A paid it on your own, debit realization, credit bank. If you incurred but never paid, till debit realization, and we said you credit provision for liquidation. That's number 4. 5, any assets that was not taken over from you as A, but you sold it on your own, just go debit bank, credit the asset. Is a gain or loss on disposal? Take it, the realization account. Told you, you are not running the normal business. Otherwise, the gain or loss, I would have taken it to the P&L. Not running a normal business, we are reconstructing. Any gain or loss on disposal goes to the account. That was number 5. Number 6 said, with liabilities not taken over, but paid by you, selling company. Debit liability, credit bank. And we have said, is any discount you are receiving from your creditors, transfer it where? The realization. That's what we said. That's number 6. And I've said, listen, 8, 7, 8, and 9. That's what I want you to remember. They are all related. They are all related. That was the time where we were creating a liability account. Stakeholders. One group of stakeholders are the ordinary. Told you, anything you owe to them, take it. Take it. Count. Okay? Whether ordinary, whether share reserves, whether fictitious assets, all those things belong to them. Number 7, it's part of the ordinary share capital. You have to debit share capital to close it, credit the member's account. Number 8, the transferred reserves, positive or negative. That's what I did. Premium or retained losses, transferred to the member's account. Number 9, we transferred any fictitious assets. Told you these are assets company A could not give to B, or A could not sell on their own. They could get a buyer. Patents, copyrights, preliminary expenses as an asset. In other words, mostly they are the intangible assets. They are the intangible assets. Normally in a question, they are normally the intangible assets. Good. You transfer them to the members by giving them that loss of the assets. Then number 10, do the same for preference. You owe something to the preference, you can't pay them direct to their share capital. Open a liability account for them. 10, say transfer the balance of the preference share capital to the members. And I've also said, NB, there's any arrears of the dividend, debit realization, credit the members. 11, receive from the B. You are A, receive from B now. How much? Charging them 50. Receive it. Either cash, shares, or debentures. Debit cash, debit shares, debit debentures, credit the purchasing company. 12, pay the preference. Whatever the question will tell you, whether cash, shares, or debentures. Debit the preference shareholders, members, credit bank, cash, or whatever. That's number 12. 13, whatever is the balance in the preference shareholders, that being a gain or loss on payment, take it to the realization. 14, the balance in the realization account, being either gain or loss on selling your business, that is being a gain or loss on realization. Takes over the gain or loss on selling the business, the owners of the company. Who are the owners? The ordinary shareholders. That was our step number 14. Finally, number 15 said you pay the ordinary shareholders what is due them. You pay the ordinary shareholders what is due them. Next time, we shall now discuss the entries in the books of selling company. Yeah? Good. Sorry, in the books of the purchasing company. Maybe before we leave, again, let me request, I have said, if you are listening to this and you have not subscribed, please subscribe to my YouTube channel. If you have not subscribed, you can even click that subscription button right now. If you have not subscribed, please subscribe so that we notify you whenever we post videos into the YouTube. You can even click the notification bell. Okay? The other thing you can do is you can like the video. If you have at least learned something today, click that like button. Okay? I hope you have learned something today, that you now know how to close the books of the company that is selling their business. You like the video, click the like button. Okay? Then I've said now, the general everybody now, please recommend these online classes to your friends. Tell them we have advanced financial reporting. We have for financial reporting advanced, tell them we have either evening classes or early morning classes. Our evening classes starts from 8 p.m., 10 p.m. every Monday, Wednesday, and Saturday. Monday, Wednesday, and Saturday. If they choose evening. If they choose early morning, it's from 5:30 a.m., 7 a.m. every Monday, Wednesday, and Friday. Monday, Wednesday, and Friday. Tell your fellow students who are doing financial reporting that we also have financial reporting online classes. Those ones are from every Tuesday, Thursday and Friday from 8 p.m. to 10 p.m. Okay, good. The other thing is this. Let me now mention for everyone now. If you miss a class for whatever reason, don't panic. You can still watch the video of the class that you missed. Whenever you miss a class, don't panic. Just go back to the group where the link was posted. Click on the link and you'll be able to watch the video of the class that you missed. That's important. Okay? The other thing I need to tell you so that you tell your friends, we are also offering financial accounting for foundation level. Financial accounting for foundation level, and that one of 80D1 and 80D2. There is also financial accounting in foundation of CFA and CS. Still offer online classes for those ones because the syllabus is the same as that of CPA. Good. Either of the subjects, tell your students, fellow friends, we are charging 4,200 for the whole semester. And we are accepting payments on installments. We are accepting payments on installments. Okay? The other important thing you can tell them is this. If they join the class now, they will still be able to get the video of the classes they have already missed. Let them not panic. What about the previous classes? Give the videos of the previous classes. We give the videos of the previous classes. Good. Finally, give them this number. Whoever wants to call can call using 0722 65 8875. Whoever wants to call that number and we can talk. 0722 65 8875. That is the number. Somebody wants to call 0722 65 8875. Otherwise, see you next time. Hope you have understood something. You have understood. Like the class, even you now. Don't have to wait for your friends. Just click the like button if you have liked the video or the class for today. Then if you have not subscribed, please subscribe. If you have not subscribed, please subscribe by clicking that subscription button. Otherwise, see you next time. See you next time. Bye for now. Bye for now. Sorry, before I even forget, I was almost forgetting. Either of the classes, we also have what we call pre-recorded videos. We also have what we call pre-recorded videos. There are some students who may feel they cannot be able to attend live classes, but they need the classes. So they can buy what we call pre-recorded videos for any of the subjects. For any of the subjects, you can buy the pre-recorded videos at the same cost of 4,000. Or whenever you want pre-recorded videos, they are also available. See you next time. Bye for now. See you next time. Bye. Bye for now. Okay.